What if I told you Bitcoin just crossed a line and most people didn't even notice? BlackRock, the largest asset manager on earth, just made a move that could quietly take control of Bitcoin's future. And it didn't happen in the spot price. It happened in something far more dangerous, the derivatives market. Because just days ago, BlackRock's Bitcoin ETF options surpassed Deribit, the platform that has dominated crypto options for years. This isn't just a milestone, this is a power shift. And if you don't understand what's happening right now, you might be playing the wrong game entirely. And if you want to understand where Bitcoin is actually going, not the hype version, not the Twitter version, you need to hear this. This video is for educational and informational purposes only. Nothing discussed here constitutes financial advice. Cryptocurrency markets are highly volatile. Always do your own research and consult a licensed financial professional before making any investment decisions. Welcome to the Wealth Continuum. I'm glad you're here. And I need you to stay with me until the very end, because the final piece of what I'm about to show you is the part that most channels will never cover. Let's get into it. Let me paint a picture for you. It is 2016. Bitcoin is sitting somewhere around $700. The mainstream world thinks it is a joke. Banks are dismissing it. Governments are ignoring it. And a little platform called Deribit quietly opens its doors. Deribit was not built for Wall Street. It was not built for hedge funds or pension managers. It was built for the people who actually believed in Bitcoin when nobody else did. The crypto native traders. The people who understood that you could not just buy and hold forever. You needed tools to trade volatility, hedge your positions, and generate income on your holdings. And Deribit delivered exactly that. For nearly a decade, it was the undisputed king of Bitcoin derivatives, the dominant force in Bitcoin options, the place where serious traders came to express complex views on the market. Think about that for a moment. 10 years of dominance. 10 years of being the most important venue for Bitcoin derivatives on Earth. Now here is your first question, and I want you to actually think about your answer before I give you mine. How long do you think it would take for a brand new competitor to come in and match what Deribit built over an entire decade? 5 years? 3 years? What if I told you the answer is less than 18 months? Because on Friday, the 25th of April, 2026, data tracked by the decentralized crypto volatility protocol Volmex confirmed something extraordinary. The open interest in options tied to BlackRock's iShares Bitcoin Trust, the ETF known as IBIT, reached $27.61 billion on NASDAQ. Deribit's Bitcoin options open interest on the same day, $26.9 billion. For the first time in history, a traditional Wall Street financial product has overtaken the crypto-native derivatives king that ruled this space since 2016. IBIT options launched in November of 2024. They crossed Deribit in roughly 18 months. Let that land for a second. Comment below right now. Did you know this had happened? Yes or no? I genuinely want to know who in this community was already watching this develop. Before we go deeper, I need to make sure you fully understand what Deribit actually is, because a lot of people hear the word derivatives and their eyes glaze over. But if you do not understand derivatives, you do not understand Bitcoin. It is that simple. Options are contracts. They give you the right, not the obligation, to buy or sell an asset at a specific price on a specific date. A call option is a bet that the price goes higher. A put option is a bet that it goes lower. An open interest measures how many of these active contracts are sitting in the market right now. It tells you the scale of participation, the depth of conviction, the size of the bets being placed. Deribit was where the smartest Bitcoin traders in the world came to place those bets. When volatility was exploding, Deribit was the arena. When major price moves were coming, Deribit was where the positioning showed up first. And then in August of 2025, Coinbase acquired Deribit for approximately $2.9 billion, the largest acquisition in crypto history at that point. Even Coinbase, one of America's most recognized crypto companies, understood that Deribit was the crown jewel of Bitcoin derivatives. So when I tell you that a BlackRock ETF product, launched less than a year and a half ago, has now matched and surpassed that crown jewel, you need to feel the weight of what that means. Stay with me, because the next part is crucial. Because this is not just a story about two numbers, 27 billion versus 26 billion. This is a story about two completely different worlds colliding. And what happens when they collide is going to affect every single Bitcoin holder on the planet. One world is Deribit's world, crypto native, global, offshore, accessible to sophisticated traders everywhere who understand leverage, volatility, and how to navigate a market that does not sleep. The other world is IBIT's world, regulated, onshore, institutional. The world of pension funds, endowments, asset managers, hedge funds, and wealth management desks sitting inside glass towers on Park Avenue. These two worlds have very different goals, very different timelines, very different strategies. And now for the first time, they are playing the same game at the same size. Hit. Like right now, if you think this is one of the most underreported developments in Bitcoin's entire history. Because I genuinely believe it. Here's where I am going to challenge something you might believe right now. There's a popular story in crypto circles that goes like this. Institutions are coming, and that means price goes up. Simple, straightforward, bullish. And yes, there is truth to that narrative on a long enough timeline. But here is what they are not telling you. Institutions are not just buyers. Institutions are architects. They do not enter a market to chase the same price movements that retail traders are chasing. They enter a market to build infrastructure around it, to position on both sides of volatility, to engineer liquidity, and yes, to profit from the positioning mistakes of everyone else in the market. Let me show you exactly what I mean with the data we now have from Volmex on the current IBIT versus Deribit positioning. IBIT call options, the bullish bets placed by Wall Street, are currently pricing in Bitcoin near $109,709. That is not a typo. $109,700. Deribit's positioning? Bullish as well, but more measured. Their calls are concentrated around $106,000. So right away, you can see that institutional investors on the IBIT side are actually betting more aggressively on Bitcoin's upside than the crypto native traders on Deribit. Wall Street is more bullish on Bitcoin than crypto traders themselves. Think about why that might be. These are not people who get swept up in social media hype. These are systematic, analytical, data-driven investors who do months of research before deploying capital. And right now, their models are pointing to prices significantly above where we are trading today. But here is the part that requires nuance. There is another structural difference between IBIT and Deribit that reveals something very important about how the institutional world is thinking about Bitcoin. IBIT options have a longer average expiry date. Weighted by open interest, IBIT options are approximately 2 months longer dated than Deribit. IBIT investors are concentrated in October 2026 expiries. Deribit traders are focused on August 2026. What does that tell you? It tells you that Wall Street is playing a longer game. They are not trying to catch the next 2-week move. They are positioning for where Bitcoin will be 6 to 8 months from now. They are building positions with patience and precision. That is an entirely different mindset from the average retail trader who is reacting to every candle, every tweet, every macro headline. And you need to understand this before I show you what's next. Because this structural difference in how institutions think is actually the most important thing I'm going to tell you today. Let me give you one more layer of data that almost no one is discussing. IBIT's implied volatility is currently higher than the implied volatility derived from Deribit's Bitcoin options. Now, for those who are not deeply familiar with options mechanics, implied volatility is essentially the market's forecast of how much the price is going to move. High implied volatility means the market is expecting large swings. Low implied volatility means the market expects relative calm. So why is IBIT's implied volatility elevated compared to Deribit? Here is the fascinating structural reason. ETF holders, the people who own IBIT shares, cannot easily short Bitcoin directly. They do not have access to the same borrowing and short selling infrastructure that professional crypto traders use on offshore platforms. So when they want to hedge against downside, the only tool available to them is buying put options. This constant structural demand for put options is keeping IBIT's implied volatility slightly elevated above the market. And what does elevated put option demand tell you from a sentiment perspective? It tells you that even as IBIT call options are pricing in Bitcoin at $109,000, there's simultaneously a meaningful cohort of institutional investors buying insurance against a downside move. They are hedged on both sides. They are not one-dimensional bulls. They are managing risk in a sophisticated way that most retail participants simply cannot replicate. This is where it gets really concerning if you are approaching Bitcoin the way most people do, reacting to price, chasing momentum, sizing positions based on confidence rather than structure. Because the people on the other side of your trade right now, they have both directions covered. Subscribe to the Wealth Continuum if you want to keep understanding how the smart money is actually thinking about these markets, because this is exactly the kind of structural analysis we are committed to delivering for this community. Let me step back and give you the full picture of what the Bitcoin derivatives market looks like right now, because the concentration numbers here are genuinely extraordinary. IBIT and Deribit together, just those two venues, now control approximately 90% of the entire global Bitcoin options market. 90%. Between two platforms. And IBIT, the product that did not exist until November 2024, is now the single largest venue for Bitcoin options on the planet. Meanwhile, the rest of the market, OKX, Binance, CME, every other exchange, is splitting the remaining 10%. Now, here's a question I want to throw at you, and I want you to really sit with it. When nearly the entire derivatives market for an asset concentrates in two venues, one of which is controlled by the world's largest asset manager with over $10 trillion in assets under management, What does that do to price discovery? Who gets to set the narrative? Who gets to define what fair value means? Who has the capital and the positioning to move prices in the direction that serves their book best? I am not suggesting anything nefarious. Institutional market dynamics are legal. They are part of how sophisticated markets work. But you need to understand the game you are playing in, because right now, the Bitcoin options market has become a two-player arena, and one of those players is BlackRock. Comment below, does this concentration make you more confident or more cautious about Bitcoin's short-term price action? I want to hear your thinking. But here is what they are not telling you in most of the coverage of this story. There is a regulatory filing sitting with the Securities and Exchange Commission right now that tells you something very important about where this is all heading. NASDAQ ISE, the exchange where IBIT options trade, has formally requested that position limits for IBIT options be increased from 250,000 contracts per side to 1 million contracts per side. Read that again. They are asking to quadruple the current limits, and the argument they are making to the SEC is telling. They are saying that IBIT is now comparable in scale and liquidity to some of the largest global equity benchmark ETFs in existence. They want to put IBIT options in the same regulatory tier as products like iShares MSCI Emerging Markets, products that institutional desks have been using for decades. If that request is approved, and there is every reason to believe it will be, the institutional capacity in IBIT options is about to explode by a factor of 4. This is not incremental growth. This is a structural expansion of Wall Street's ability to deploy capital into Bitcoin derivatives. Think about what this means for liquidity, for price stability, for the relationship between Bitcoin's spot price and its derivatives markets. The game is changing at a regulatory level, not just at a market level. Stay with me, because I have one more connection to make that brings all of this together. So where does all of this leave us? Let me lay out 2 scenarios, not as predictions, but as frameworks for thinking. Scenario 1, the institutionalization of Bitcoin's derivatives market becomes the foundation for its most stable, sustained, and significant bull run in history. Deep liquidity, sophisticated hedging, long horizon positioning, covered call strategies generating yield on massive IBIT holdings. This creates a market where price appreciation is slower and steadier than the wild cycles of the past, but also more durable, less susceptible to single event crashes, more attractive to the next wave of institutional capital waiting on the sidelines. In this scenario, Bitcoin starts to look less like a speculative asset and more like an institutional grade store of value. And the call options pricing in $109,000 before the end of 2026 look like the conservative end of the range, not the optimistic one. Scenario 2. The very concentration of power we are describing creates fragility in a way the market has not experienced before. When one entity commands this level of derivatives market influence, the max pain mechanics, the price levels where the most options contracts expire worthless, become tools for positioning rather than neutral market phenomena. Retail traders who follow old cycle playbooks find themselves consistently on the wrong side of engineered volatility events, because the entity setting the agenda is playing a multi-month game while they are playing a multi-day game. In this scenario, the short-term path to $109,000 is not a straight line. It runs through retail liquidation events, sharp corrections that shake out weak hands, and volatility spikes that benefit the people who own the implied volatility rather than the people who are exposed to it. Which scenario do you think is more likely right now? Think carefully before you answer, because I think the honest answer is that both scenarios are happening simultaneously for different time frames. Share this video with someone in your life who is holding Bitcoin right now but has no idea this derivatives shift is happening. Because the difference between understanding this and not understanding it could be the difference between being on the right side or the wrong side of the next major move. Let me zoom all the way out now. Because when you take everything we have covered today and you look at it from 30,000 feet, here is the story that is actually being written right now. Bitcoin was born as an alternative to the traditional financial system. It was built on the idea that ordinary people could hold and transfer value without needing permission from banks, governments, or Wall Street. And for the first decade plus of its existence, the derivatives markets that gave Bitcoin its financial maturity were built and controlled by crypto-native players. Deribit, FTX before its collapse, BitMEX in its heyday, platforms that lived offshore outside the reach of traditional regulators, built for and by people who believed in what Bitcoin represented. That era is not over, but it has been joined by something entirely different. Because now, the largest asset manager in the world, a company with more than $10 trillion under management, controls the biggest Bitcoin derivatives venue on Earth, from inside the regulated infrastructure of the United States financial system, listed on NASDAQ, overseen by the SEC. And the question this raises is not whether this is good or bad for Bitcoin. The question is what it means for every person who holds Bitcoin today. Because in the old world, you were competing against other crypto traders. People who understood the technology, who lived through the cycles, who had skin in the game going back years. In the new world, you are increasingly sharing a market with institutions that have trillion-dollar balance sheets, decades of derivatives experience, and the regulatory infrastructure to scale their Bitcoin exposure in ways that would have been unimaginable just 2 years ago. That changes how you need to think about your position, your timeline, your risk management, your strategy. And it makes the kind of analysis we do here at the Wealth Continuum more important than ever. Not because we are going to trade this market for you, but because understanding the structure of a market is the only way to avoid being its casualty. So let me leave you with a few questions that I genuinely want you to think about and drop in the comments below. Does the institutionalization of Bitcoin's derivatives market make you more bullish, more cautious, or simply more informed? Do you think Bitcoin can maintain its original ethos as a people's asset while simultaneously becoming the primary playground for the world's largest financial institutions? And here's the big one. If BlackRock is positioning its call options at $109,700 for before the end of 2026, and Deribit's crypto-native traders are targeting $106,000, what does the retail investor who is not using derivatives at all actually do with that information? Comment your answer below. This community has some of the sharpest thinkers in the space, and I read every single response. If this video gave you something you did not have before you clicked play, a framework, a data point, a question you had never asked, hit the like button. It genuinely helps this analysis reach more people who need it. Subscribe to the Wealth Continuum if you are serious about understanding where wealth is really being built and moved in this new financial era. We do not do price predictions. We do not do hype. We do the structural analysis that the mainstream crypto media skips because it is harder to make a thumbnail out of. Until next, stay informed, stay patient, and stay on the right side of the shift. This is the Wealth Continuum. See you in the next one.